So when we're talking about mitigating your estate tax, how do you combine that with charitable planning and philanthropic planning? There's a lot of creative ways that you can go here. So for wealthy families, the estate tax situation is a really big deal. And generally what we find is that a lot of folks that have high levels of wealth have it in different pockets of their world. There's money in real estate holdings, there's individual investments like stocks and bonds, mutual funds, professionally managed accounts, a lot of wealth built in retirement accounts. And so this seems really good, right? So we'll see situations where a couple will have $5 or $10 million just in their retirement accounts. And people say, well, that's great, I could live off of that. Well, the problem is this, right? Let's say you're 75 years old and you and your spouse collectively have $10 million in your retirement accounts. You're now required to take distributions from that account every year. And at that level, I mean, those distributions are sizable. They are huge, over, in some cases, $500,000 plus per year. And you might be saying, well, all right, I could live on $500,000, and most can. But the problem is that's all taxable income. Because when it is in your retirement account, you got the deduction every year that you were saving, right? If you made, say, $100,000 when you were 30 years old and you put $20,000 into your 401k, right? You only got taxed on $80,000. Because in the future, whatever that $20,000 investment you made that year, whatever that grows to, when you are forced to take it out, which is your required distribution, the IRS wants ordinary income on that. So if that $20,000 turned into $200,000 over a long period of time, and you pull that out, that's ordinary income. So now you find yourself in your retirement years potentially back in the highest tax bracket. That's wild. And in many cases, you may not need the assets from your retirement account because you have other assets you're living on. Maybe you have rental income, you have other investments and distributions that are coming that are much more tax efficient, but you're forced to do this. Right. So, and to add insult to injury, there was a law passed in I think it was 2017 or 2018. It was when the Secure Act was passed, where they changed the rules on IRA, not just distributions, but on inheriting IRAs. Previously, before the Secure Act, if you inherited an IRA from, let's say, your parent, a non-spouse, any non-spouse, you'd have to take a required distribution, but it was off your life expectancy. So if you were 40 years old and you inherited your parent's IRA, you're taking smaller distributions over your life expectancy, which could be, 50, 60 years, right? And it's spread out. Once the Secure Act passed, that changed. And now if you inherit an IRA from a non-spouse, all of that money has to come out of the IRA in 10 years.